You graduate at 22, you get a job, you make $65,000 a year, you think you're okay. Then your first paycheck lands and something feels wrong. You made roughly $5,400 that month. You received about $3,400. You didn't buy anything, you didn't gamble, you didn't take a vacation. You existed for 30 days, you pushed through 40 hours a week, and the government already extracted 37% of your labor before you touched a single dollar. Now here's where it gets interesting. Your boss, who owns the company, made $400,000 last year. His effective tax rate? Probably around 19%. His college friend who owns a portfolio of rental properties and index funds? Maybe 15. The guy who inherited a commercial building in Ohio, never interviewed for anything in his life, and lives off capital distributions. His heirs will inherit that asset with a stepped up cost basis and pay almost nothing. So the question isn't who's earning more. The question is, why does the person who works the hardest, the youngest person on the team, the one with no assets and the most to prove, consistently end up subsidizing a system that was designed before they were born, optimized for people who are already done working and structurally incapable of giving them back what they put in? Who is actually paying for this government? We're going to explain how this machine works and why, for your generation specifically, it keeps getting more expensive. I want you to think about a conveyor belt. Not a smart one, an old industrial one, the kind you'd see in a factory floor that smells like grease and broken promises. This conveyor belt moves in one direction. It starts at your first W-2 job, and it moves toward a single exit point, the tax bucket. Everyone on the belt pays. But here's the architecture of it. Some people are bolted to the belt. They ride it straight into the bucket at full speed. And other people figured out how to step off, walk alongside it, toss in the occasional contribution, and mostly avoid the trip entirely. Gen Z, you're bolted to it. Not because you're bad at money, not because you're lazy, because the architecture of this tax system was built in a different era by people who were already off the belt and they had absolutely zero structural incentive to unbolt you. That's the thesis. Let's build the case. The first thing you need to understand is that when most people talk about taxes, they're talking about the wrong number. They say, I'm in the 22% bracket, and they think they've understood the conversation. They haven't even opened the right chapter. Your effective tax rate is the real percentage of income you pay in taxes, not your marginal bracket. So let's run the actual math on a real scenario, because I think most people have never actually done this. You're 24, you got a decent first job, $65,000 a year in a moderate tax state, let's say 4% state income tax. After your standard deduction, your federal effective rate lands around 13 to 14%. That takes out roughly $8,500. Then we add Social Security at 6.2% on wages up to the current cap. That's another $4,030. Medicare comes in at 1.45% for both employers and employees. Another $942. State income tax at 4% is $2,600. Added up, you're losing roughly $16,400 before you do anything. That's about 25% of your gross income gone. And that number assumes you live in a low tax state. If you're in California, New York, or New Jersey, you can add another 4 to 6% on top and watch it climb past 32. But here's the part that almost never gets discussed. Both you and your employer pay 6.2% on your wages up to the cap, and once an employee earns more than that cap, neither pays Social Security tax on the excess. Think about what that actually means. The Social Security tax, which is billed as a flat contribution, is functionally regressive above that earnings ceiling. A person making $700,000 a year pays Social Security tax on only the first $184,500 of it. Their effective Social Security rate as a percentage of total income is a fraction of yours. You pay it on every single dollar you earn. Full stop. No deduction, no strategy, no loophole. No accountant trick that changes it. You earn from a job, you pay payroll taxes. The belt is moving and you're bolted to it. Now here's the reversal that matters. You think the progressive income tax is the problem, but actually the payroll tax is the problem, because income tax is visible, argued about, adjusted seasonally by politicians who want your vote. Payroll tax just exists quietly in the background, taking almost 8% off the top of your check every 2 weeks like a subscription you never signed up for. And here's the structural irony that makes this almost funny. According to the Harris poll, 57% of Gen Z workers now run a side gig. compared to 21% of boomers and older Americans. So the generation getting hammered hardest by the existing tax structure is simultaneously the generation most likely to have additional self-employment income. And guess what self-employment income does to your tax situation? You have no employer covering any portion of payroll tax. You are responsible for income tax and the full 15.3% self-employment tax on every dollar of income. So the generation working the most angles, hustling the hardest, building the most income streams is simultaneously paying the highest blended tax rate. The belt isn't just moving. For you, it's moving faster. And the darkest part, only 10% of Gen Z know the exact tax rate applicable to their income level, 42% have a general idea but are unsure of the precise rate, and 49% don't know. Nearly half of the generation paying the most in payroll taxes doesn't know what they're paying. That's not an accident. That's just what happens when a system is designed for compliance, not comprehension. Now let's get to the generational math, because this is where things go from annoying to genuinely strange. Social Security is not a savings account. I know you know this, but I don't think most people have sat with the real mechanics of it. When you contribute to Social Security, the money doesn't go directly into your account. It goes into a fund that pays for current retirees' benefits. There is no investment account growing in your name. There is no allocation with your name on it. It is a live transfer. Your money taken from your paycheck today goes out to a retiree today. The moment it comes in, it's gone. Now, here's the structural issue that makes this a genuine problem rather than just a philosophical one. In 1960, there were more than 5 workers paying Social Security taxes per beneficiary, but that ratio has dropped to less than 3 to 1. That's down to about 2.7 now and on track to reach 2.3 in a decade. So when the baby boomers were in their 20s, 5 workers were splitting the bill for every retiree. Today, you're one of roughly 2.7 people splitting it. By the time you retire, the ratio is probably close to 2 to 1. The math doesn't close. The math has never been designed to close for you specifically. You are paying full price into a system that will deliver a discount product in 45 years. How discounted? The Social Security Trust Fund has a projected reserve depletion date of 2033. Unless Congress acts, current and future beneficiaries alike will see their benefits cut by 23%. And if you want to be extra precise about it, Congressional Budget Office analyst Molly Dahl told the Senate Budget Committee that the trust fund could be exhausted as early as 2032. And without congressional action, retirees could see a 28% reduction in benefits. So to be completely honest about the range, sometime between 2032 and 2034, depending on which estimate you trust, the trust fund runs dry. After that, the system can only pay what it collects in real time, which means somewhere between a 23 and 28% automatic benefit cut happens the moment that clock runs out. You are 22 right now. You retire in 2068 at the earliest. The fix has to happen before 2032, and it hasn't happened yet. Nobody in U.S. politics wants that to happen, but there are deep divides over how to address the imbalance. And fiscal watchdogs have warned of its unsustainability for decades. But what is different now is that it is no longer a far-off problem. But here's the incentives problem, and this is the part I want you to actually sit with. The people who vote in the largest numbers in this country are retirees and near retirees. Cutting Social Security benefits for current recipients is not happening. Raising the retirement age is political poison. Raising payroll taxes is slightly less politically toxic but still deeply unpopular. So every year the problem gets acknowledged, published in a report, cited in a news article, and then absolutely nothing happens. Policymakers from both parties have known for decades that Social Security's finances are unsustainable, but have consistently failed to act, leaving the program an estimated $25 trillion short over the next 75 years. $25 trillion. That's the unfunded obligation sitting on the books of a program you're required to pay into. And notice what this is. It's not corruption, it's not a conspiracy, it's just incentives operating exactly as designed. Voting power shapes policy priority. The generation with the highest voting turnout wins the resource allocation battle. Old people vote consistently at higher rates than young people. Old people win. The conveyor belt keeps running. And the structural result of that incentive architecture is a tax burden that falls most heavily on the people with the least political leverage. Young, employed, no assets. Just starting. You know what Social Security is? It's a group project where the people who graduated 5 years ago already turned in their portion, got the grade, left the class, and you're still sitting there finishing the poster at midnight. Except the poster is your retirement, and the class is your entire working life. If what I'm breaking down here is useful to you, subscribe. I make these regularly, and I'm not planning to stop. The second half of this video goes deeper. Now let's talk about the part of the tax code that almost nobody explains correctly to young people, and it's the single most important structural advantage that wealthy people have over you: the capital gains rate. Here's the number you need to know. Long-term capital gains, meaning profits from assets held longer than 1 year, are taxed at a federal maximum of 20%. Wage income is taxed at a federal maximum of 37%. That's 17 percentage point gap. That is the entire architecture of wealth inequality in this country. Everything else is downstream of that one structural difference. Let me give you a clean comparison. Person A works in project management at a mid-sized firm. $200,000 a year in salary. After federal taxes, payroll taxes, and a 4% state income tax, they keep about $127,000. They work 48 weeks a year. If they stop working, the income stops immediately. There is no passive continuity to their cash flow whatsoever. Person B has been investing for 15 years. They hold a diversified portfolio and a small commercial property. This year, they generated $200,000 in long-term capital gains and net rental income. After the federal capital gains rate and after depreciation deductions on the property offset a portion of rental income, their total tax bill on that same $200,000 lands around $30,000 to $35,000. They keep $165,000 to $170,000. Same gross income. Person A keeps $127,000. Person B keeps $167,000. And person B also wakes up the next morning with assets that are still generating returns, whether they look at a screen or not. Now, here's the official explanation for why this gap exists. The argument is that lower capital gains taxes incentivize investment and risk-taking, which allocates capital to productive uses, which creates jobs, which grows the economy for everyone. And to be fair, there's a real economic argument there. Capital allocation does matter. Investment does fund the businesses that employ people. But here's what that argument quietly skips. You cannot access the capital gains rate without first owning capital, and you don't own capital at 22. You own a laptop and a lease and $42,000 of student debt at 6% interest. So the capital gains discount is structurally inaccessible to you until you've spent a decade or more paying the higher income rate, building savings, and accumulating enough assets for the tax structure to actually benefit you. The people who capture the most benefit from the capital gains preference are the people who were already wealthy enough to have significant investable assets before you started working. The system doesn't reward effort or risk. It rewards existing ownership of productive assets. You can't bootstrap your way into the capital gains world without first surviving the income tax world. And the income tax world is expensive. There's also a layer here that most people completely miss. The depreciation deduction on real estate is essentially a license to reduce your taxable income on paper while your actual asset appreciates in real terms. A person who owns a rental property can deduct a portion of the building's value every single year, even if the property is actually going up in value. The IRS assumes the building is wearing out. The market disagrees. So on paper, the landlord is losing value. In reality, they're building equity. That paper loss reduces their taxable rental income. In a good year, a landlord with several properties can wipe out their entire rental income with depreciation and pay zero federal tax on that income. Your rent, which funded that depreciation, is not deductible to you in any form. Not a cent. Let me walk you through a specific scenario to make this concrete. I'll call this person Tyler. Tyler is 26. He grew up in a normal house. His parents rented their whole lives. He went to college, graduated with $42,000 in student debt at 6% interest, and landed a solid first job as a project manager, making $70,000 a year in a state with a 5% income tax. Let's build Tyler's actual financial picture. Gross annual income, $70,000. Federal income tax at his effective rate after standard deduction, roughly $9,800. Social Security at 6.2%, $4,340. Medicare at 1.45%, $1,015. State income tax at 5%, $3,500. Total taxes paid before he sees a single dollar, approximately $18,655. That's 26.6% of his gross income. Gone before breakfast. Before rent. Before a single choice has been made, he takes home just over $51,345. Now, his fixed expenses, he lives in a mid-tier city, one-bedroom apartment, $1,400 per month or $16,800 per year. Student loan payment of $450 a month, $5,400 per year. Car payment, insurance, and gas, about $400 monthly or $4,800 per year. Groceries and basic living, $700 a month or $8,400 per year. Phone, subscriptions, miscellaneous, $250 a month or $3,000 per year. Total fixed expenses, $38,400 per year. What's left? $12,945. Roughly $1,078 per month to invest, save, build any kind of future, or handle literally any unexpected cost that comes along. Now let's think about what Tyler is paying into and what he's getting back. Tyler is paying Social Security, which, as we established, he will almost certainly receive at a reduced rate decades from now, if at all in full. He is paying Medicare, a healthcare system that will matter to him in 40 years. He is paying state taxes that fund public pensions for government employees, most of whom are in defined benefit plans that Tyler himself will never have access to. His employer offers a 401k with a 3% match. He's contributing, he's not asleep, but here's what the system won't let Tyler do. Tyler cannot deduct his rent. His rent is his largest single expense by a significant margin. The person who owns the building Tyler lives in can deduct mortgage interest, property taxes, maintenance, repairs, insurance management fees, and depreciation. Tyler paid every one of those costs indirectly through his monthly check and received zero deduction. The cost flows up, the benefit flows to the owner. The conveyor belt runs smooth. Tyler also cannot access the capital gains rate in any meaningful way yet. His 401k grows tax deferred, which is genuinely good, but it locks up the money until he's in his 60s. His emergency fund sitting in a high-yield savings account generates interest taxed as ordinary income. His path to the lower tax world requires first surviving the higher tax world, and that takes time, compounding, and a savings rate that his remaining $12,900 a year makes extremely difficult to scale. Tyler is not failing. Tyler is running a race where the course itself was designed in an era of 3 times income home prices, defined benefit pensions, and a Social Security ratio of 5 workers per retiree. None of those conditions exist for Tyler, and the tax structure built around those conditions has not been meaningfully updated to account for the difference. There's a whole generation of people who bought a house in 2012 for $250,000, refinanced at 3% in 2021, watched it appreciate to $550,000, and are now confidently explaining to their 25-year-old that the problem is they spend too much on avocado toast. Let's be clear about what happened there. The house went up $300,000 in value. The coffee costs $6. Those are not the same category of financial event. One of those things required discipline and restraint to fix. The other one required a mortgage in 2012. The window was the advantage. The window is now mostly closed. Now we get to the part that very few people in the personal finance space actually discuss directly, because it requires saying something uncomfortable out loud. The national debt in early 2026 sits somewhere around $36 to $37 trillion. Now, before your eyes glaze over, let me give you that number in a frame that actually means something. There are roughly 260 million adults in the United States. If you divided the national debt equally among every adult, each person's theoretical share would be around $140,000. But here's why that framing is actually charitable to the situation. A large and growing portion of the adult population is retired or near retirement and exiting the net taxpayer pool. The people who will be working, earning, and paying net income taxes for the next 4 decades are the people who are currently in their 20s and early 30s. The actual per working adult burden is higher than the headline number. Significantly higher. And here's what makes this a genuine second tax on young people. The trustees project that the combined trust fund reserves will continue to decrease because total cost is expected to exceed total income. That gap year after year gets funded by government borrowing. The interest on that borrowing now exceeds the defense budget as a single line item. We're spending over $1 trillion a year just servicing existing debt. That is not building infrastructure. It is not funding new programs. It is purely the cost of having borrowed so much for so long. Every dollar of that interest payment represents a future claim on someone's taxes. The future taxpayers are you. This is not abstract. This is arithmetic. Now, I'm not here to assign blame to any specific generation. That framing isn't useful, and it ignores the real driver: incentives. Politicians respond to electoral pressure. The electorate that shows up most consistently is older. The benefits they demand most loudly are Social Security, Medicare, and low capital gains taxes. The politicians who cut those things lose elections, so the politicians who want to keep their jobs don't cut those things. The debt grows, the interest compounds, and the tab for all of it eventually lands on the people who are too young right now to vote in large enough numbers to change the political calculus. That's not cynicism. That's just the operating logic of a democratic system when participation rates are distributed unequally by age. There's also an inflation layer to this that gets almost no attention. Think about 2021 through 2003. The Federal Reserve expanded the money supply substantially during and after the pandemic. Prices across virtually every major category went up 15 to 20% in aggregate over roughly 2 years. Groceries, rent, cars, insurance, utilities, everything moved. Inflation is, in economic terms, a tax on cash. If you hold dollars and prices go up 15%, your purchasing power went down 15%. The government did not write you a check for that loss. No agency reported it as a tax. It just happened silently to everyone holding dollars. Who got hurt the most? The people with no assets. Young people in cash savings accounts watched their purchasing power decline in real terms. People with fixed-rate mortgages on homes they bought in 2015 effectively had their real debt burden paid down by the inflation. The asset owners got an invisible gift. The cash holders paid an invisible tax. The same inflation event created two completely opposite outcomes depending entirely on whether you owned things or not. This is the pattern. Every major economic event of the last 15 years, the 2008 financial crisis, the post-pandemic monetary expansion, the rate cycle, has disproportionately benefited asset owners and disproportionately punished people without assets. And the generation that entered the labor market during or after those events is the generation that started with the fewest assets. So now let me give you the part that this whole video has been building toward. Because this isn't just an analysis of injustice. That's boring and it doesn't move your net worth. What matters is, what does the tax code actually tell you to do? Because the tax code is a signal. It is the most detailed, legal, publicly available instruction manual for what behaviors the system rewards and what behaviors it punishes. Everything you've heard today is encoded in that signal. And once you read it honestly, the path forward becomes less emotional and more architectural. The first takeaway is this: understand the structural difference between income optimization and asset accumulation, and prioritize the second deliberately. Income is taxed at the highest rates. Income also stops the moment you stop producing it. It has zero passive continuity. Assets, by contrast, generate returns taxed at lower rates, continue generating whether you're working or not, and compound over time in a way that wages cannot. This does not mean quit your job tomorrow or abandon your salary growth goals. Your income is the engine, but every extra dollar your engine generates needs to be evaluated on one question: how quickly can this be converted into an asset? A salary increase that goes entirely into a higher standard of living does nothing for your tax position or your long-term trajectory. The same salary increase invested into index funds or directed toward a down payment on a small rental property starts the clock on a different kind of wealth. One that the tax code treats better. One that puts you closer to the exit ramp of the belt. The single most important metric at your stage is not your annual income. It's the percentage of your net worth that is in income-producing assets versus labor-dependent income. That ratio should shift in the direction of assets every single year. Track it. That is the actual game. The second takeaway is this: treat the 401k not as a retirement savings vehicle, but as a tax arbitrage instrument, because that's what it actually is. When you contribute pre-tax dollars to a traditional 401k, you are moving money out of your current marginal bracket and into a deferred tax environment, where it grows without annual taxation. One of the easiest ways to lower your tax bill is by contributing to a 401k if you have one, because contributions are subtracted from your taxable income reducing the taxes you owe now while helping you save for retirement. If you're in the 22% bracket now and you reasonably expect to draw that money in a lower bracket during retirement, you just captured a 10 percentage point arbitrage on every dollar contributed. On $24,500 of contributions in 2026, that's a $2,450 tax advantage captured in a single year. Not a small number. Not exciting. Also, one of the only structural tools the tax code puts directly in the hands of a salaried employee. The maximum employee pre-tax contribution increases to $24,500 in 2026. Use it. It is one of the rare points where the belt slows down slightly and you can step half off. The third takeaway is this. Plan your retirement as if Social Security will deliver 70 to 75% of currently projected benefits. Not zero, not full. If the Social Security retirement fund is depleted in 2033, the program would be able to pay only 77% of scheduled benefits. And that assumes the 2033 date holds, which the Congressional Budget Office now suggests may be 2032. Either way, the math points clearly in one direction. Plan for a meaningful reduction, build your own retirement infrastructure around that assumption. The generation retiring today gets, in many cases, a defined benefit pension, full Social Security, and Medicare coverage that has been running for 30 years. You are almost certainly getting none of the first, a reduced version of the second, and a Medicare system under fiscal strain. Social Security is only designed to replace approximately 40% of your paycheck. If it delivers 30% instead, and you planned for 40, you're fine. If you planned for 40 and got 30, and you had no other infrastructure, the gap is real. Build the infrastructure now. That means consistent investment, tax-advantaged account maximization, and a savings rate that treats Social Security contributions as a long-shot bet rather than a guaranteed pillar. There's also a fourth thing, and I'm calling it zero because it precedes all the others. Understand the system before you try to optimize inside it. Only 10% of Gen Z know the exact tax rate applicable to their income level. That number is disqualifying. You cannot navigate a machine you haven't read. The tax code is free to read. The IRS website publishes all of it. Every deduction, every rate, every structure is documented. The reason most people don't know these things isn't because the information is hidden. It's because school optimized you for employment, not for financial architecture. Employment is great. It's the engine, but understanding the tax structure around that employment is the difference between riding the conveyor belt at full speed and actually figuring out where the exit ramps are. Let me come back to where we started. You got your first paycheck. $5,400 became $3,400. You thought something was wrong. Nothing was wrong. That was the system functioning exactly as it was designed. A design built in an era when the worker-to-retiree ratio was above 5-to-1. When housing cost 3 times your annual income, not 8 or 9. When defined benefit pensions were standard. When the national debt was a fraction of its current size. When the capital gains preference served a meaningfully different economic function. None of those conditions exist today, and the structure hasn't meaningfully changed. You are not the problem. Your spending habits are not the problem. The problem is that you inherited a tax architecture optimized for a set of economic conditions that no longer exist. And the political incentive to update it is almost non-existent, because the people with the most voting power are the people who benefit most from the existing structure. That is the machine. That is the conveyor belt. And now you know where the exit ramps are. The question isn't whether the system is fair. Fairness is interesting, but it's not actionable. The question is whether you're going to spend the next 10 years being surprised every 2 weeks when your paycheck looks wrong, or whether you're going to use the actual signal the tax code is sending you. Own things. Structure matters. The form your money takes when it reaches you is worth more than the amount that reaches you. Every year you delay building asset-based income is a year the compound math works against you instead of for you. The system rewards certain behaviors and punishes others. Always has. The people who got rich quietly were the ones who read the signal correctly and acted on it without waiting for it to be fair first. If you want more of this kind of breakdown, subscribe. New video when it's done.